Unless you've been off-grid or living under a rock, you've noticed that a lot has changed over the last few years. Not just in our personal lives, but in the markets, in prices, and in how money actually moves through everyday life. Yet most of the commentary I see still relies on the same rhetoric it always has, as if the structure underneath hasn't shifted. But we know it has. Now, to be clear, we do have a discipline problem, we do have a debt problem, and we do have a mismanagement problem. But that's not the full story. The system changed, but behaviors didn't change with it. And when that happens, people don't just fall behind financially. They get frustrated, confused, and discouraged even when they're doing many things right. With the Pointe Perspective, we're working to change that, one step at a time, week over week. I'm Christiana Lovelace. I'm a licensed financial advisor and an accredited asset management specialist, and I own Diamond Point Financial. In today's discussion, we're going to do three things. First, we'll put tech stocks into perspective so that when you hear them discussed, especially the Magnificent Seven, you actually understand what's driving the conversation. Second, we'll talk about inflation and what it truly means, because the narrative most people have been fed over the last few years doesn't fully explain what's happening beneath the surface. And third, I'll walk you through what it looks like to start creating real control over your finances in a modern system, one that no longer relies on the outdated practices you've always been taught. And before we go, I'll also share how we've adjusted our own process here at Diamond Point, not for compliance or because we were told to, but because we want to better serve our clients and our team in a more intentional way. Do not be fooled into thinking that just because the market went up, that all or even most of the stocks went up. For the last several years, only a handful of companies have actually been doing the heavy lifting. Now, when I refer to the market, I'm generally talking about the S&P 500, which is an index that tracks 500 of the largest publicly traded companies in the US. And what a lot of people don't realize is that indexes are weighted, which means a small number of very large companies can pull the entire market higher, even while a large portion of the stocks fall behind or go nowhere at all. So when investors say the market did well, the more useful question I want you to start asking is, which part of the market did well, and how concentrated was that return? Because that concentration changes risk, it changes expectations, and it changes how portfolios should be evaluated. Tech stocks are a hot topic, and it might always be this way. They used to be the sexy mistress, then they were treated like the faithful wife, but the truth is they're probably somewhere in the middle. And that's the best way to describe what people now call the Magnificent Seven. It's not just a cute nickname, it's a small group of mega cap technology companies that have driven a disproportionate share of market performance. But contrary to what some people believe, tech is not a guarantee. It's not a fling and it's not a religion. Like every other sector, it's a tool. And tools work best when you understand what you're holding. The Magnificent Seven are made up of 7 of the largest and most influential US tech companies, and together they make up roughly 35% of the entire S&P 500's market capitalization. So to put that in perspective, out of 500 companies, just 7 account for more than a third of the entire index. Those companies are Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. And while they've driven most of the gains over the last few years, they've also added a significant amount of volatility. So sure, in 2023, without those stocks, the market would have been in the negative, but that's mainly due to their recovery after 2022. Those 7 stocks fell more than 40%, while the broader S&P 500 declined closer to 19%. Now, I'm not telling you this to encourage you to buy them or scare you out of them. I think the news already does that well enough. I'm telling you this so you can understand how experienced investors put these stocks into perspective. They can be a magnificent part of the portfolio, but they should not be the portfolio. A disciplined portfolio is built with structure across multiple industries with different styles and risk exposures, all put together to create balance and control. Because the moment you get more focused on winning, you stop investing and you start gambling. There is a whole town in Nevada built on gamblers, but it's not because they won. Contrary to what we've been told over the last few years, inflation is not just prices going up. Prices go up because inflation already happened. Have you ever seen a picture of a glacier? That tiny piece above the water surface is your prices going up, and that's what we see and feel as consumers. But the huge majority of the glacier is under the surface. That's where real inflation is. Inflation is the erosion of purchasing power. It moves through the system first and then shows up in what you pay. So prices are the symptom, but they're not the cause. And if you misunderstand that, you will aim your frustration in the wrong direction and you'll make weaker decisions because of it. There are 3 common types of inflation. First, demand pull. This occurs when consumer demand grows faster than the supply of goods. Remember what we talked about last week with supply and demand? That's this. The next is cost push inflation. This happens when the costs of production increase and businesses pass those costs on. If the products used to create a product go up, the company is not going to absorb that increase. They're going to pass it on to us, the buyers. And lastly, built-in inflation. This is a cycle that's built in our behaviors. It's when workers expect prices to keep rising and demand higher wages, which then results in the business having to raise prices in order to maintain their profit margin. Like I mentioned, companies are not going to just eat that cost. Recently, we've seen all of these happen and in a very short amount of time, which is why it has been so painful. Now, if you are mismanaging your money, that is absolutely on you, but just know that that's not the only cause of feeling like you're left behind. A lot of responsible people are doing the right things and still feel squeezed because wage growth has not kept up with inflation, costs don't rise evenly, and purchasing power tends to erode very quietly. But please keep in mind that this too shall pass. Times of high inflation do not last forever, and we have already seen the growth of prices slow down. Not necessarily go down, because that's a whole other issue, and we can talk about that next week. But when the growth slows down, we're able to actually take a breath and reevaluate your situation for the next time this happens, because it will happen again. As a strategic retirement planner, it used to be really hard to get clients to understand the implications of inflation because they hadn't dealt with it yet. It wasn't tangible yet. Now that we've felt the effects of it, everyone understands how detrimental it can be in retirement, and it forces you to start asking better questions like, where do I see my purchasing power declining in the future? And which expenses are rising the fastest? And of course, what needs to change structurally in my financial life so I'm not constantly playing defense? Too many people ask, how do I budget better? But that is the wrong question. And I'm going to be very direct here. I've said it once, I will say it again. Budgeting is dead. Unless you are willing to live a cash-only lifestyle, which most people are not, traditional budgeting does not work the way it used to. Our digital society has changed all of that. Spending is automated, subscriptions renew quietly, and expenses fluctuate from month to month. Budgets assume predictability, but predictability is not the reality for most households. That's why so many people feel like they're bad with money, even if they're not. So you say you want control over your money, but if you really want control, you have to stop guessing where your money goes and start analyzing it. Now, sometimes people get uncomfortable with this because the thought of analysis almost feels confrontational, but it shouldn't. The first step is awareness. So I want you to pull the last 6 months of your bank statements. Not just scrolling the transaction list, but your actual statements. You're going to evaluate the averages of those months and identify companies and areas your money flowed into. This isn't to pick apart every mistake, but to look for patterns and to pay attention where your money consistently goes. You can do this manually, and if you are a finance nerd like me, it might be fun for you, but most banks already offer cash flow charts and spending categories inside their apps. If they do, use them. They are there for a reason, and they can be very beneficial. If your bank doesn't provide that, there are plenty of tools online that can help you with it. Now, this isn't about judgment or beating yourself up over spending regrets. It's about data, because you cannot control what you do not understand. Once you have clarity around your actual cash flow, where your money is going, and how much might actually be discretionary, then you can start making intelligent decisions. Everything we've talked about today, markets, inflation, cash flow awareness, directly shapes how we operate at Diamond Pointe for our clients. When it comes to reviewing strategies, the industry minimum standard is 1 annual review. And that has never aligned with how I believe thoughtful planning should work. So we changed it. We redesigned our process so clients now receive 2 intentional touch points instead of just 1. Our fall reviews are focused on preparation, reviewing data, updating information, and identifying changes in cash flow priorities or life circumstances. That allows us to properly prepare for tax strategies, estate planning, and insurance considerations. Spring reviews are focused on strategy, where we connect the dots across investments, taxes, and long-term retirement planning. This structure allows us to provide guidance that's comprehensive and proactive instead of reactive. It also gives clients more clarity and confidence heading into decisions rather than trying to fit everything into one single meeting once a year where important items are more likely to be missed. This has been one of the best structural decisions we've made, not just for our clients, but for our team, because structure is what allows good planning to happen consistently, even when life and markets aren't so predictable. As we wrap up, I want to leave you with this. Clarity in investing doesn't come from watching whatever you're told is important today. It comes from understanding what's actually changing underneath the surface and how those changes show up over time. Financial success is created through perspective and structure, and through the discipline to look at what's real instead of what's loud. When you understand how markets are behaving, what inflation really is, and how money is actually flowing through your life, you stop reacting and you start building a framework that allows you to move with intention even when conditions change. That's what we focus on here, and that's what we continue to build on, one step at a time, week over week. So until next week, take care.